What is the break-even point? We are business planners, so we can help you with your business plan and financial model in Excel. Subscribe for more videos. Please like and share to help the channel grow. If you want to calculate the break-even point correctly, you have to distinguish clearly two types of costs. First type of cost doesn't increase or decrease if revenue increases or decreases. Basically, it remains the same. Another type of cost increases if revenue increases and decreases if revenue goes down. Before any calculations of break-even point, you'll have to divide all expenses in two groups: direct costs and stable costs. This is the first step for an entrepreneur to calculate the break-even point correctly. First of all, let's take some business as an example. We will bake the strawberry pie. What is basic idea of break-even point? Break-even point is a specific amount of pies or a specific revenue from selling pies when your revenue is equal to your expenses. So let's explain what the break-even point is. Here we have a selling price of 1 pie. Then we enter sales plan in pies for 1 month. Then we specify direct costs that we need to bake just 1 pie. To bake 1 pie, we need flour, sugar, strawberry. Here we specify the price for each component. The price per kilogram of flour, sugar and strawberry. Then we specify the consumption of each component. How many kilograms of flour, sugar and strawberry do you need to bake 1 pie? Then we have totals for each component and total for all direct costs which we need to pay if we want to bake just 1 pie. Then you have a payroll table where you mention all positions in your business and salaries. We have 1 manager and 3 bakers. The salary of a manager is $1,500. The salary of a baker is $1,100. You may also have some monthly paid fixed costs like rent, advertising, administrative expenses, loan payments, and so on. Here they are. Now it's time to calculate the monthly profit. Here we have the revenue, pies sold multiply selling price. Direct costs, direct cost of 1 pie multiply sales plan. Then we have total fixed costs. We take it from here. Then we take a total of your payroll from here. Then you calculate your taxes. At the end, you get your profit. It's revenue minus direct costs minus fixed costs minus payroll minus taxes. So now you have a profit. Now it's time to calculate the break-even point. Step 1. Selling price minus direct cost of 1 pie. Step 2. We get a total of all monthly expenses except direct costs. Fixed costs plus payroll plus taxes. Step 3. We divide the result of step 2 on the result from step 1. This is our break-even point in pies. If we bake this amount of pies, our revenue will be equal to our expenses. If you want to know the break-even point in dollars, you should move to the step 4. We multiply the result of step 3 on selling price and get the revenue which will be equal to our expenses. This will be the revenue of break-even point. Let's check the break-even point result. We take the break-even point in pies and multiply it on selling price. Then we calculate direct costs for your break-even amount of pies. Then we take our fixed costs, our payroll, and our taxes. And finally, we calculate the profit. It's revenue minus direct costs minus fixed costs minus payroll minus taxes. Here you have a zero profit. This means that this revenue is a break-even point in dollars and this amount of pies is a break-even point in pies. This was break-even point. If this video was useful to you, please like, share and subscribe. Should you choose to take action in your startup, we can help you with business planning and financial modeling. Let's test your business idea. Stay tuned and bye-bye.